Everyone loves a high yield, 10%, 12%, even more. But if these funds pay that much, who's paying the price? Because in investing, someone always does. The truth is, most high-yield ETFs aren't magic. They trade away future growth for short-term income. But a few manage that trade carefully, balancing yield and stability instead of burning through your capital. So what happens when you put $100,000 into those, the covered call ETFs that actually get it right? In this video, I'll show you and John exactly that. I'll break down how covered call ETFs actually make money, why their yields are so high, and what separates sustainable income from risky yield traps. We'll look at 3 of the top funds, and in the end, I'll put them together into a realistic $100,000 portfolio to show you how this one-time investment could grow into a portfolio worth over $2 million, generating more than $20,000 in monthly dividend income. But first, let's start from the top. What exactly are these covered call ETFs? And how do they pull off these double-digit payouts everyone's obsessed with? Let's strip away the jargon and keep it simple. Imagine you own a bunch of stocks, big names like Apple, Microsoft, Johnson & Johnson. Normally, you make money in 2 ways. 1, the stock price goes up, or 2, you collect dividends. Now, covered call ETFs add a 3rd way to make money. They rent out their potential upside for extra income. Here's how it works. These funds sell something called a call option. In plain English, that's just a deal that says, if my stocks go above a certain price, you can buy them from me, but you'll pay me a fee right now for that chance. That upfront fee is called the option premium, and that's the money that becomes your monthly dividend payout. So the ETF is basically saying, we're okay giving up some of the future price growth in exchange for guaranteed income today. That's why they can afford to pay you 8%, 10%, or even 12% per year. It's like renting out your house every month. You collect steady rent, but you can't sell the house for as much profit later because you've given up some of its future potential. That's the trade. Steady income now, less growth later. Some covered call ETFs sell calls on part of their portfolio, meaning they still have room to grow. Others sell calls on 100% of it. That's how they get the huge yields, but those usually sacrifice almost all of the upside. And that's where most people get it wrong. They chase the biggest yield without realizing how different these funds really are in how they make money. So before you invest a single dollar, the real question isn't which one pays the most, it's which ones are actually built right for long-term sustainability. That's what I'm breaking down next. Alright, so if all covered call ETFs claim to pay big monthly income, how do you tell which ones are actually good? Because not all of them are built the same. Some are smart and sustainable, designed to balance growth with income, while others bleed your capital just to keep those yields looking high. The difference comes down to a few key things, and once you understand them, it's easy to separate the solid ones from the traps. The first thing to check is what's inside the ETF. That's called the underlying index, basically the list of stocks it owns before writing any options. A covered call ETF built on strong, diversified companies, indexes like the S&P 500 or the NASDAQ 100, has a much better foundation than one built on thin, volatile sectors. The stronger the base, the steadier the income stream. Then comes the call strategy. How much of the portfolio is being rented out? Some ETFs write calls on 100% of their holdings, locking in the biggest yields, but leaving no room for price growth. Others cover only a part of the portfolio, maybe 30 to 40%, allowing for some upside when markets rise. It's the classic trade-off. Bigger checks now or more long-term potential later? Next, you want to think about consistency. Anyone can post a huge yield one month, that's easy when volatility spikes, but the best funds keep their payouts relatively stable over time. Consistent income comes from smart management and high-quality holdings, not just luck in a volatile market. Fourth, management style matters too. Some ETFs are actively managed by professionals who can adjust their strategy depending on what's happening in the market. They can dial back on covered calls when markets are running hot and turn them up when things cool off. Others are completely mechanical. They follow a fixed formula every month no matter what. Active management tends to sacrifice a little yield but gives you smoother performance long term. You'll also want to look at the cost. Covered call ETFs are more complex than regular index funds, so their fees are naturally higher. But once you get above 0.5% and close to 1%, those costs start eating into your yield. It might not sound like much, but over years, that difference compounds just like returns do. And finally, remember that volatility works both ways. When markets get jumpy, these ETFs earn more from selling options, which means more income for you, but the same volatility can push prices down. The best funds manage this balance well, capturing high premiums without letting capital erosion spiral out of control. So when you blend all these elements together, a strong index, smart coverage ratios, stable payouts, reasonable fees, and adaptive management, you end up with the kind of covered call ETF that can actually stand the test of time. And when you apply that filter across the whole market, only a few really pass. Next, I'll show you the 3 covered call ETFs I shortlisted. And in the end, I'll put them together into a realistic $100,000 portfolio to show you how this one-time investment could grow into a portfolio worth over $2 million, generating more than $20,000 in monthly dividend income. All right, so after filtering through the noise, the hype, the yields, and the hidden traps, 3 covered call ETFs consistently rise to the top. Each one does the same basic thing. They own a basket of stocks and sell options for income. But how they do it and how much risk and growth potential you get is completely different. Let's start with the one that's often called the Smart Income Choice, JEPI, the JP Morgan Equity Premium Income ETF. JEPI is actively managed by JP Morgan, and its portfolio is built around large, stable S&P 500 companies. The twist is that it only sells covered calls on part of its portfolio, usually around 20 to 40%. That gives it a nice balance between steady monthly income and a bit of room for price growth. Its average yield hovers around 8%, which is solid, but what makes JEPI special isn't just the income, it's the consistency. Because it's active, it can adjust to different market conditions, which helps smooth out volatility and protect your capital better than most competitors. Now, if JEPI is the steady one, QYLD, the Global X NASDAQ 100 covered call ETF, is the income powerhouse. It writes covered calls on 100% of its holdings every single month. That's how it delivers those massive double-digit yields, often 12% or more. But here's the catch. Because QYLD sells away all of its upside every month, its share price barely grows over time. It's fantastic for generating cash flow, but not great for long-term price appreciation. So you get a big income today, but you're giving up growth tomorrow. And then there's XYLD, the Global X S&P 500 covered call ETF. It's kind of the middle ground between JEPI's balance and QYLD's aggressiveness. XYLD also writes calls on 100% of its S&P 500 holdings, but because the S&P isn't as volatile as the NASDAQ, the yield tends to sit a bit lower, around 10 to 12%. That trade-off gives XYLD more stability than QYLD, but less growth potential than JEPI. It's steady, broad, and simple, a great complement to the other two. So if we simplify, JEPI gives you balance and stability, XYLD gives you steady, high income with broad diversification, and QYLD gives you maximum yield with minimal growth. Each plays a different role, but when combined thoughtfully, they can create a portfolio that generates serious income while keeping risk in check. Okay, now before we jump into the $100,000 portfolio and the real numbers, we need to talk about something that most people skip over: the trade-offs. Because yes, covered call ETFs sound incredible on paper: high income, monthly payouts, low effort. But those big checks come with some strings attached, and understanding them is the difference between a smart investor and a disappointed one. The first trade-off is growth. Covered call ETFs trade future upside for income right now. When the market rises fast, these funds give up a lot of that potential because they've already sold away the right to participate in those gains. That's the cost of getting those high monthly premiums. So when everyone else's portfolios are shooting up 15%, you might only see 5%. The second trade-off is that your income isn't fixed. It can look super consistent month to month, but it still depends on volatility, how wild the market is. When things are calm, option premiums shrink, and so do your dividends. When volatility spikes, income jumps again. It's reliable, but not guaranteed. Third, the price itself can slowly decline over time, especially for the more aggressive funds like XYLD and QYLD. You'll still collect your dividends, but if you check your account balance a few years later, you might notice the share price hasn't moved much or has actually drifted down a bit. That's not a crash, it's just how this trade-off works. Fourth, there's the tax angle. Those monthly payouts often get taxed as ordinary income, not the lower rate that qualified dividends enjoy. So if you're holding these in a taxable account, your after-tax yield might be a little lower than it looks on paper. However, if you keep them in a tax-free account and reinvest those dividends instead of withdrawing them, the picture changes completely. Each payout buys more shares. Those shares generate more income, and that income buys even more shares. Over time, it snowballs, turning regular payouts into powerful compounding growth. So, now that we've talked about how covered call ETFs work, how to pick the good ones, and what the trade-offs are, let's finally see what happens when you put it all together. Here's a simple, realistic portfolio built from 3 of the strongest covered call ETFs: JEPI, QYLD, and XYLD. Each one gets an equal share, 1/3 of your total investment in each fund. JEPI has a current yield of 8.34% and is assumed to maintain 8% long-term gain. QYLD yields 12.67%, expected to hold around 12%. XYLD yields at 12.8%, also expected to maintain about 12%. Together, this mix creates an average yield of roughly 10.5%, with modest long-term price movement, around minus 0.7% per year on average once you factor in the natural drag from call writing. Now, let's say you invest $100,000 and simply let it ride, reinvesting every dividend along the way. Here's what happens over time. After 1 year, the portfolio is projected to be valued at around $109,756. By year 10, it's expected to reach $262,088, driven primarily by reinvested dividends rather than price appreciation. By year 20, the portfolio value is projected to grow to about $740,802. At year 30, the same $100,000 investment is estimated to be valued at roughly $2,269,932, paying around $263,170 in annual dividend income, or about $21,931 in monthly income. Overall, the total value added is projected to reach about $2.17 million, including around $2.3 million generated from dividend reinvestment, minus $139,424 in price erosion. Want more value? Click the video on the screen to find the best index fund that can turn a $100,000 investment into a $12 million portfolio.